Hey, I'm Ben from Modern Graham, and today I want to talk about Truist Financial Corp. This company, with the ticker TFC, is currently trading at about 44.71 as of recording this. It is from the financial services sector, and it is a bank. So here we have the balance sheet items that I find the most important. We have current assets, current liabilities. You can see that they have many more current assets than current liabilities, which you would expect, and they have a bit of long-term debt. They have total assets that are pretty solid and intangible assets, and then, of course, total liabilities and shares outstanding. Then we come down here to the earnings, and you can see that the earnings have gone steadily up for the most part. They have kind of stabilized in the middle. You can see that on the graph here, that blue is the earnings. They kind of came up, and then you hit the financial crisis, and then they've been coming up since then again. EPS MG is earnings per share Modern Graham. That is a weighted average, taking the last 5 years of earnings per share, putting the most weight on the most recent. So for the current fiscal year or the next fiscal year, the estimate is 409 in terms of earnings per share, Modern Graham. And then dividends, we can see that the dividends per share have kind of followed the same trajectory where they were going up and then they went down for the financial crisis, and they've been on their way back up again. You can see the dividend payout ratio is pretty low right now. They tried to keep their dividend pretty high for a while during that financial crisis, but they had to cut it at one point. So you can see that on the graph here. Dividends per share were growing well, and then they had to cut them, and then they've been growing again pretty steadily since then. So let's get into Modern Graham valuation. The first stage is to figure out if the company is suitable for the defensive investor. So the defensive investor requires that the company pass 6 of the following 7 tests. The first one is an adequate size of the enterprise. The market cap has to be over $2 billion. It passes that. That one is easy for companies of this nature to pass. Then number 2 is sufficiently strong financial condition. The current ratio, which is the current assets divided by the current liabilities, has to be over 2. Right now, this one is 4.02, so it passes there as well. Earnings stability. It needs to have a positive earnings per share for 10 straight years. It has achieved that. And it has to pay a dividend for 10 straight years. It has achieved that as well. Earnings growth. We need to see at least a 1/3 growth in earnings per share over the last 10 years using 3-year averages at the beginning and end. And we have achieved that, so it gets another pass there. Moderate PEMG ratio. PEMG is price over the earnings per share Modern Graham. It needs to be under 20, and it has passed that. The price over earnings per share Modern Graham, the PEMG, is 10.94. Then the last one for the defensive investor, it needs to have a price to book ratio under 2.5, which you take the price and divide it by the book value, and you get a 1.05 for this one. So it passes that. It would also pass under the second part of this test, which would be price to book times the PEMG, and that sum needs to be under 11.5, or that product. It passes that. So it actually gets 7 out of 7 for the defensive investor. For the enterprising investor, by default, it is suitable, but we will go through for all of this. It is suitable by default because it is suitable for the defensive investor. But we'll go through each of these anyway. Current ratio is greater than 1.5. It's at 4.02. Debt to net current assets. So you take the total debt, you figure out the net current assets, which is current assets less current liabilities, and then you take the debt divided by the net current assets, and it is not under 1.1. It is very close, but it fails that. Positive earnings per share for 5 years, it passes that, and it currently pays a dividend, past that too. Earnings growth, earnings per share Modern Graham is greater than 5 years ago, passes that too. So, like I said, it passes for the enterprising investor because it is suitable for the defensive investor, but it would pass on its own for that as well. Stage 2, we want to figure out the intrinsic value. So we take the modern Graham value formula, which is based on the formula given by Benjamin Graham, the father of value investing, in his book, The Intelligent Investor. And that is value equals earnings per share modern Graham times 8.5 plus 2 times the growth rate. So we need to figure out earnings per share modern Graham, which is, again, the weighted average here, 4.09, and then the growth. What I do to figure out growth is I take the current year's earnings per share, and then I look at 5 years prior. So we go down here, 5 years prior, that's 3.11. I calculate the total growth between those times, and then I divide it by 5 for the 5-year, the average growth. That is 6.28%. Then I kick in a safety margin here. So I always want to assume that the company will not grow quite as well as it has historically. So that's why we have a safety margin in there. And the growth estimate there is 4.71% after that safety margin. Then we can plug these figures into our formula. We take the earnings per share modern Graham, 4.09, and the growth estimate of 4.71%. We get a modern Graham value of 73.20. Net current asset value is negative for this one, which we don't have to worry about that. I'll talk about that in a moment as well. And if we were to put 3% growth in here with that earnings per share modern Graham, we would have a value of 59.26. If we had a 0% growth, it would be a value of 34.74. So the market implied growth rate, if we were to put the price of the company here and the earnings per share that we have here, and then solve for growth, we would get 1.22%. So if you think that this company will grow greater than 1.22% in perpetuity, then you would think that this is undervalued. That's another way of looking at this. So in summary here, the modern Graham opinion is the current price of $44.71 is only 61% of the intrinsic value, which again was $73.20, and so therefore the company is undervalued. Now remember, I don't make any buy or sell recommendations. I'm just giving you the information of what my opinion of the price is and where it compares to the current price, or my opinion of the value compared to the current price, and you need to make your own decisions based on that. Going further, the modern Graham grade, which takes into account several different factors like the suitability, it gets 2 points for being a defensive investor company. It is undervalued, so it gets another point. It's trading below its Graham number, which we'll talk about in a minute. That gives it another point. It has not achieved more than 20 straight years of dividend growth, so it does not get a point there. It has a dividend yield above 2%, so it gets half a point there. It's trading at a PEMG below the average for its industry, so it gets another half point there, but it's not great trading below its net current asset value. So its total score is 5, which over here gives it an A. So then stage 3 is to do further research. So this part is where you need to look at it closer to decide if you think this company would be suitable for your individual portfolio. I can't answer that. I can't tell you if it's a good buy or not, but I can tell you that I think it's an undervalued company. And looking at further research, if we look at the net current asset value, which is the current assets minus the total liabilities, divided by the outstanding shares, this would give you a liquidation value. And for this one, it's negative. So it doesn't really apply, but just know that if a company is trading below its NCAV, it might be a really great deal. Now, it also might come with a bit of risk because it is trading that low, but it might be a good opportunity. The Graham number formula. The Graham number was created by somebody at some point. I'm not quite sure who, but it is kind of a derived formula from some of the defensive investor requirements. And so it is another way of kind of summarizing some of Graham's teachings. And that comes to 6607 when you run the calculation. And again, the company is trading below that number. So that is another indicator that it might be undervalued. And again, the price to earnings modern Graham formula results in a PEMG of only 10.94. That's a price multiple. And so it helps to figure out what the value, or like one way of comparing values. Other useful information: current ratio is 4.02, the price to book ratio is 1.05, dividend yield is 4.4, and there have been 12 consecutive years of dividend growth. Now we will move on to stage 4. Okay, so for stage 4, I think that it is important to, like, if you've decided that it is a potential buy and you have it on your watch list, then the next thing is to look at the chart and try to figure out when might be a good time to buy. This one, we're looking at the daily view, and this goes back to 22, or the beginning of the year here, and it started to trend down, and you can see that coming down, and then here it broke above that, and it has been staying and bouncing above that trend line. This here is a support level that it hit a few times down here, supported, or it made that into a pretty strong support line that it recently fell under. So now I would be looking at this to see what happens. Does it come back down, and will it break down below this? In which case, I would probably hold off on buying it for a while. But if it breaks above this, it might be an indication that it's going to rise. Down here, we also have the RSI indicator, and that kind of shows a little bit of momentum. I've put in moving averages to my chart, and you can see that up here it was overbought, and it came down because of that. Down here, it was underbought or oversold, and it started to level off because of that. Now it's been coming back up, and it kind of, I mean, right now, this is the longer, where the shorter average moved over the longer one. So that's another thing I'd really be watching, is to see where that momentum goes, especially if it breaks above that. It might have the momentum. So it will be an interesting one to watch this week. And yeah, anyway, so now if you have enjoyed this video, I think you should click on the video on the screen now. This company was a part of a list of 10 high yield dividend stocks that I looked at the other day. And if you want to see the other ones, it's in that video. So, but in the meantime, thanks for watching, and I will catch you next time. Take care.